let me tell you about the greatest bait-and switch in modern financial history. Not crypto, not prop trading, not even the housing market. I'm talking about something that 70 million Americans are actively participating in right now, at this exact moment, while calling it a benefit. I'm talking about the 401k. And before you close this video and go back to whatever financial podcast is currently telling you to max your contributions, hear me out. Because the 401k isn't a scam in the way that prop trading is a scam or crypto is a scam. It's subtler than that. It's a system that looks like it was built for you, uses your money, carries your name, and yet was architected in a way that transfers risk onto you, extracts fees from you, and limits your choices in ways you almost certainly never agreed to, all while your employer takes a tax break for offering it to you in the first place. Here's the thing. Before the 401k existed, most American workers at large companies had something called a defined benefit pension. The name says exactly what it is. Your employer defined the benefit. They promised you a specific monthly payment in retirement, and they were responsible for investing the money to make that promise real. If the market tanked, that was the company's problem. If the fund was mismanaged, that was the company's problem. The worker showed up, did the job, and retired knowing exactly what they'd get. Then came 1978. Congress added a tiny provision to the tax code, Section 401k, that allowed employees to defer a portion of their salary into a tax-advantaged account. It was originally designed as a supplemental benefit for executives, not a replacement retirement system for the entire American workforce. But here's what happened next. Companies saw it, and companies realized something beautiful. They could use this obscure tax provision to shift the entire burden of retirement funding from the corporate balance sheet onto the individual employee. And they did it in less than 20 years. Between 1980 and 1998, the number of private sector workers covered by traditional pension plans dropped from 38% to under 20%. Today, it's closer to 12%. The defined benefit plan didn't die. It was killed, replaced by a system that looks like it gives workers more control, but actually just gives companies less liability. Let that sink in. In one generation, American workers went from being promised a retirement to being handed a tax-advantaged account and told good luck. Now here's where the numbers get interesting. Because the 401k system currently holds roughly $10 trillion in assets. That is an enormous pool of captive capital. And I say captive because that's exactly what it is. If you change jobs, you can roll it over. If you need the money before age 59 and a half, you pay income tax plus a 10% penalty. You can't easily move it to a different brokerage. You can't buy individual stocks in most plans. You can't opt out of the fund menu your employer selected. You are locked inside a curated list of investment options that were negotiated between your HR department and a fund company. And that negotiation, by the way, rarely had your long-term returns as the primary variable. Here's how the mechanism actually works. A company sets up a 401k plan through a plan administrator, usually a large financial institution like Fidelity, Vanguard, or Principal. That administrator offers a fund menu. Inside that fund menu are mutual funds, target date funds, and maybe a handful of other options. Each of those funds carries fees. And a portion of those fees, sometimes called revenue sharing, sometimes called sub-transfer agency fees, sometimes buried inside the expense ratio under line items no one outside the industry can decode, flows back to the plan administrator. Not to you, to them. For the privilege of being on the menu that you had no choice but to use. The average 401k plan fee, when you add up all the layers, administrative costs, investment management fees, individual service fees, sits somewhere between 1% and 2% annually. Some plans, particularly at smaller employers with less negotiating leverage, can run closer to 2.5% or even 3%. Now run that against the same 30-year compounding model we used before. A $200,000 investment earning 7% per year at a 2% annual fee load ends up at roughly $650,000. At 0.1% in a self-directed account, that same money ends up at over $1.1 million. That's $450,000 in the difference. Extracted. Legally. From an account with your name on it that you were told was a benefit. And then there's the target date fund problem. Target date funds are marketed as the set-it-and-forget-it solution. Pick the year you plan to retire, choose the corresponding fund, say, a 2055 fund, and the fund automatically adjusts its mix of stocks and bonds as you get older. It sounds elegant. It's the financial equivalent of a meal prep service. Convenient, automatic, and priced accordingly, because target date funds are not cheap. The average expense ratio on a target date fund is around 0.5% annually, which doesn't sound bad until you realize most of them are just funds of funds, meaning they're a fund that invests in other funds, all of which charge their own fees on top. The total cost can stack. And the performance record is, to put it charitably, uninspiring. Over a 10-year period, the majority of target date funds underperform a simple two-fund portfolio of a total stock market index and a bond index. Not by a little, by enough to matter at retirement. Now let's talk about the employer match, because this is where people get defensive. But my employer matches 3%, that's free money. Yes, it is. And no one is saying turn down free money. But here's the uncomfortable math. An employer match of 3% is, in many cases, partially offset by the fees you're paying inside the plan over time. And the match has a vesting schedule, meaning if you leave the company before 2 to 4 years, you might not keep all of it anyway. The match is real. The benefit is real. But it's also, from a corporate finance perspective, a calculated cost that replaced a pension obligation worth several multiples of that 3%. Adjusted for the fact that the company is no longer bearing any investment risk whatsoever. The historical rhyme here is not subtle. In the early 1900s, company towns existed. Workers lived in housing owned by their employer, shopped at stores owned by their employer, and were paid in scrip that could only be spent in that same ecosystem. The company controlled the environment, the choices, and the money supply. Historians call it exploitation dressed as paternalism. The 401(k) is not that extreme. But the structural logic rhymes uncomfortably. Your retirement capital is captive inside a plan designed by your employer, administered by a financial institution your employer selected, invested in funds that pay fees back to that institution, with withdrawal rules set by the government, and your primary meaningful choice is how much to contribute. You're inside the ecosystem. You just can't see the walls. So what can you actually do? Here are the practical anchors. Always contribute at least enough to capture the full employer match. Every time, without exception. That's a guaranteed 50% to 100% return on day one before any investment. Look up your plan's expense ratios. Go to the plan portal, find the fund fact sheets, and look for the expense ratio, or total annual fund operating expenses line. If everything on the menu is above 0.5%, your employer either hasn't negotiated hard enough or doesn't particularly care. If your plan offers an index fund option, use it. Even if the expense ratio is 0.4% instead of 0.03%, it's still better than actively managed funds with a proven track record of underperformance. Roll over old 401(k)s to an IRA when you leave an employer. You break out of the captive menu problem and gain access to lower-cost options. If you're self-employed, you are not off the hook. The SEP IRA and solo 401(k) exist, and you control the fee structure entirely. And here's the uncomfortable truth that nobody on the financial planning circuit wants to say out loud. The 401(k) system was a policy choice, a political choice, made in 1978, accelerated by corporate interest, and normalized so thoroughly that most people treat it as a law of nature, like gravity or the weekend. But it isn't. It's a system. And like all systems, it has beneficiaries. The beneficiaries are the financial institutions holding $10 trillion in captive assets and the corporations that traded long-term pension obligations for a line item called employer match. The workers got tax deferral. The industry got a permanent recurring revenue stream, and the government got to call it a benefit. None of this means you shouldn't use your 401k. You absolutely should. But you should use it the way you use any tool designed by someone who had their interests in mind more than yours, carefully, with full awareness of the cost and with both eyes open. So drop your take in the comments. Do you think the 401k system is A, fundamentally fine and just needs better financial literacy, B, broken by design and due for a structural overhaul, or C, a corporate and financial industry wealth transfer that can't be fixed because too many people profit from it staying exactly the way it is? Because when $10 trillion is involved, you can be absolutely sure that someone, somewhere, is very motivated to make sure you don't ask that question. And the most dangerous retirement plan is the one you assume is working for you.